The impact of the Federal Reserve on interest rates. So much misinformation out there, so much false information, and only very little what's actually true. This is Ella Gurfinkel with Fairway Independent Mortgage, Team Ella, and we're talking Fed and mortgage interest rates today. If you listen to the fear porn that our news media has turned into, you will think that the sky is falling because the Fed keeps raising interest rates and because soon everything is going to be in the tens. And when I say everything, I'm talking about the mortgage interest rates. Interest rates will be in the tens or double digits and nobody's going to be able to afford to buy a home. And oh my God, oh my God, oh my God, Chicken Little is coming. Well, the reality is actually quite the opposite. Let's actually look at the mission or at the purpose of the Fed, as in Federal Reserve. The Federal Reserve's mission is to basically combat inflation in this current environment. Why is that important? Because inflation is the arch enemy of mortgage bonds. Why are mortgage bonds important? Very simply, mortgage interest rates are based on nothing but MBSs, mortgage bond securities. Your mortgage bonds are typically traded on different what's called coupons. So a year and a half ago, roughly, we're looking at 2.5% to 3% mortgage coupon. What does that mean to you as a consumer? Meaning if you invested in the mortgage bond securities, you were guaranteed that 2.5% or 3%, depending on the coupon, return per year for 30 years. Now, when the inflation started getting out of hand, it really did a trick on the mortgage bonds. If you're only getting a return on your investment of 2.5% and the inflation is, let's say, at 5%, what does it do to your investment? It essentially nullifies it. You're actually not making enough money to make up for the inflation. So what happened as a result, the mortgage rates started going up. The mortgage bonds lost their luster, and the investors essentially slowed down their purchases of mortgage bonds. When the purchases of mortgage bonds slow, the price of mortgage bond coupons goes down, the interest rates go up. When the Fed finally stepped in and decided to combat inflation by raising interest rates, we're talking the Fed interest rate. We're talking what's called the prime interest rate. That's the interest rate that actually either the banks borrow from the Fed at, the banks borrow from each other at. It's really the overnight short-term borrowing rate. As a result, it's the rate, because it's short-term, that only affects your short-term loans, such as credit cards, car loans, home equity lines of credit, business loans. But in no way, shape, or form, it affects the mortgage rates. So when the Fed started raising their rate, you saw your credit card rates go up. But every time the Fed raised rates, the mortgage rates actually came down because the relationship is inverse. Because any time that the Fed is combating inflation or attempting to, the mortgage bonds improve. The rates get lower as a result. So Fed raising the rates, is it bad for mortgage rates? Hell no, it's actually anything but great. The fear porn you hear on the news, I don't know if they do that on purpose or not, because guess what? Negative sells, positive doesn't. What would happen if the news actually started telling the truth for a change? You tell me. In any way, Fed action, raising the rates, have been nothing but positive for interest rates. And that's why we've gone really high in rates and started to come back down again, and that's a welcome sight. Comment, agree or disagree below. Would love to see what you think. See you on the next videos.